If you're looking to invest in the stock market, you might be pretty overwhelmed by the sheer amount of choice of stocks and funds available. Even if you know you just want to put some money into an index fund, there are still hundreds of these available. So how are you supposed to know the best ones to go for? And what sort of things should you be looking out for? In this video, we'll discuss the three main characteristics you need to consider when choosing an index fund. That's fees, diversification, and the future returns potential. And I'll list my picks for the best index funds on the market in 2025. Hi everyone, welcome back to the channel. My name's George and I've been investing in index funds for a good few years now, and I've spent a lot of time thinking about and researching the best ones on the market. But what makes an index fund good, and what are the key characteristics that we need to be looking out for? So first and foremost, index funds are designed to be low-cost investment products. They were basically invented for this purpose. So a good index fund will be one which has a low annual fee associated with it. As you probably know, keeping the fees associated with your investments as low as possible is really important, especially if you're a long-term investor, as the savings you make on the fees stays invested and will compound over the long term and can result in big differences in investment returns. A good rule of thumb that I like to follow when choosing index funds is to look for funds which have an annual fee of 0.2% or lower. Now, low fees is one of the main reasons why Vanguard's products are so popular, as they are really cheap, but as we'll see later in this video, they're not always the cheapest on the market. Secondly, a good index fund will be well diversified. And what I mean by this is it will contain stocks from a wide range of different companies from very different industries, so that you're not overexposed to any one company or industry in particular, and that you're not taking on any unnecessary risk. Now, index funds are usually very diverse anyway, as they contain lots of different stocks from lots of different industries. However, there are some indexes which place quite a heavy weight on one industry in particular, so in my opinion they're less diverse than they can be. Take the S&P 500 for example, which contains the largest 500 companies in America. Now, around 30% of this index is made up of Silicon Valley tech stocks. Think of the likes of Apple, Microsoft, Nvidia, Amazon, etc. So S&P 500 investors are quite exposed to one industry in one area. That's the technology industry in Silicon Valley. But investors in other indexes might not have this overexposure, and so therefore they're exposed to less risk. And the third factor which makes a good index fund is one which has good future growth opportunities, as in it's capable of delivering healthy returns over the long term. Now, choosing the index fund which is going to perform best over time is really the million-dollar question, and no one knows this answer for sure. But as index funds are often split up by region, as in there are some American indexes, European indexes, Asian indexes, it's important to think about where our money is going and which regions of the world and which industries have the best potential for future growth. Now, I'm not going to attempt to predict the future of the world stock markets, as I'm sure that'll just end in tears. But what I will say, and as you probably already know, the American stock market has performed exceptionally well over the last 20 years. And over the last 100 years, to be honest. And historically, the American stock market has outperformed the other developed nations in the world and has been a very sure bet for investments. And a lot of investors will tell you that investing in American index funds, in particular ones based on the S&P 500, is the way to go, as they contain most of the world's largest companies and have seen significant and consistent growth over the long term. This table on screen illustrates this point. It shows the total stock market returns of the US, the UK, France, Germany, and Japan over the last 20 years. And as you can see, the US stock market is way out in front. So does this mean that we should all go for an S&P 500 index fund over, say, other indexes like the FTSE 100, which contains the largest 100 companies in the UK? Well, maybe, but what's happened historically won't necessarily continue into the future. And like I mentioned, the S&P 500 isn't massively diversified, as it's pretty reliant on Silicon Valley tech stocks. So how do we resolve this? Well, personally, I like to try and get the best of all worlds from all stock markets, and I do this by going for a global index fund, which contains the stocks from the world's largest companies and isn't restricted to any one region of the world. And this way I can gain exposure to all regions of the world without being over-reliant on any one country or any one industry. So we've talked about what makes a good index fund. Now we'll talk about my picks for the best ones on the market currently. Now, I've explained why I like to go for global index funds, and we'll talk about the best of these funds on the market, but we'll also go through some other very good index funds, which do concentrate on a specific country or a specific region of the world. And just another quick point, all of these funds I'm about to mention are accumulating funds, which means that any dividends received will be automatically reinvested, which I think is the way to go, as it gives your investments more chance to compound. So let's get down to the best funds on the market, starting with global index funds. Now, one of the most popular global indexes in the market is Vanguard's FTSE All-World Index, with ticker symbol VWRP. However, this comes in at an annual charge of 0.22% per year, and we can do much better than that. Personally, my pick for the best global index fund is Legal & General's Global Equity, with ticker symbol LGGG, as this comes in at a very reasonable 0.1% annually. Now, you can purchase shares in this fund through a number of online platforms, most notably Trading 212 and Invest Engine, as these will give you the added benefit of not having to pay any account fees, as neither of these platforms charge an account fee. Now, if you are looking to just invest in the S&P 500 and you're comfortable with the exposure to the tech industry, then one of the most popular ways to do this is through Vanguard's S&P 500 fund with ticker VUAG, which comes in at a very respectable 0.07% annual fee. But if you are interested in minimising the fee you pay as much as possible, then I'd recommend this SPDR S&P 500 fund from State Street with ticker symbol SPXL, which comes in at an incredibly cheap 0.03% per year. Now, if you'd like to focus on Europe and the largest European stocks, including the UK, then Vanguard's Developed Europe Fund with ticker symbol VEUA is a good shout, and it comes in at a very respectable 0.1% per year. And another interesting European fund is Amundi's Europe 600 with ticker symbol MEUD, which contains the stocks of 600 very large, medium-sized and small entities in Europe, and comes in at a very cheap 0.07% per year. Now, if you're after focusing solely on the UK, then Vanguard offer a FTSE 250 fund with ticker symbol VMIG, which comes in at 0.1% per year. Or if you'd like to go as cheap as possible, I'd recommend Amundi's UK Equity All Cap with ticker symbol LCUK, which comes in at a very cheap 0.04% per year. And finally, if you're after investing in emerging markets, which usually contains Asian stocks, then Vanguard offer their Emerging Market Stock Index Fund, which comes in at 0.23% per year. And again, if you're after minimising fees, take a look at Amundi's Prime Emerging Markets Fund with ticker symbol PRAM, which comes in at 0.1% annually. Okay, so hopefully that gives you a good few options. But like I said before, if you're after exposure to all regions of the world, I don't think you can go wrong with a global index. And for me, this epitomises passive investing, as you're not choosing to put your money in any particular direction. You're just letting the global stock market work its magic and hopefully deliver returns over time. And if you're looking to do some further research, then I'd encourage you to go and have a look at justetf.com, which lists all the ETFs which are available on the market. And if you've made it this far, you might find value in my recent video where I discuss why I'm leaving Vanguard as a result of their new fee structure, which comes into force on the 28th of February 2025. Links on screen now. And if you've got any questions for me based on this video, please leave me a comment below. I'll be sure to get to them all. Thanks for watching.